Welcome to FM Radio, your go-to podcast for everything in the world of funds management. Whether you're an experienced advisor, a seasoned investor, or just starting your journey, we're here to break down the complex world of funds management, all in a way that makes sense. Each episode, we'll talk to the experts to get their insights on everything from asset allocation to risk management and give you the inside track on how decisions are made. In this episode of FM Radio, we're going to be talking about the overall investment environment. And today, I'm joined by Elston Portfolio Manager Bruce Williams. Bruce's role includes portfolio construction, management and development. He's heavily involved in the analysis of research for large caps and small caps. And because he's one of the founders of Elston, he probably has a few more grey hairs than when he started. Welcome to the show, Bruce.
Thank you, Peter. Pleasure to be here.
You're looking pretty well and pretty relaxed. You're still living the break that you've had?
Well, it'd be nice to be, but you never really let go from the day-to-day, but certainly it is good to have some time off with the family.
It would be pretty hard to switch off. And I guess if one of the founders of Elston, that'd be even more true. It'd be impossible to switch off from the day-to-day.
Yeah, it really is. I mean, anytime you open a newspaper, or you don't open a newspaper these days, anytime you turn on an iPad or a computer, there's information there that's relevant to what you do for a living. So it's very hard to leave it behind completely.
Yeah, I'm a bit of a sucker for an inception story. Like I love the whole idea of, Peter Parker and going back to the day he gets bitten by a spider. The inception story for Elston, how long ago? You talk about being a co-founder. How many years ago are we talking about?
It kicked off 1st of October 2008, so peak GFC. It's not a time I remember fondly. We were already in business prior to that, but under the Elston brand, it was 1st of October 2008. And I think back then we had a team of about 30 odd across the business. No clients, no revenue, grey hair. That's where it came from.
That's where the grey hair started. So what was the thing that inspired the beginning of Elston? What was your thought process about what you were trying to do, or I guess to make yourself different from the competition and to offer something different for clients?
It was probably the philosophy. We were operating under another company's brand and we had a different idea as to where we wanted to take the business to what they had. And so we really set up with Elston with the idea of running how we thought a business in financial services should be run. So it was very much around owning direct assets, managing for tax, so managing by tax structure. It was around integrating advice into client relationships, and that just meant you're getting the best possible after-tax, risk-adjusted outcomes possible. I mean, everyone talks about returns, and that's absolutely the way it's done, but there's also the risk side of things and the tax side of things. And so it was really a case of coming up with a model where clients were happy with the way that they were being charged for that service, and they were also comfortable with what it is you were producing out the other end. And so most clients have accountants. The accountants may say, set up a self-managed super fund or a company or a family trust, or indeed in your own names. And it was around us providing services that aligned with that advice. So they weren't working at cross purposes. If you think about it, it's really an integrated outcome for the end customer. That flowed into, there are two separate sides to the business. You've got the advice side, which is what we're talking about there. But you've also got the asset management side. So it rolled into the actual investments. Historically, unit trusts were the vehicle of choice, and that's you and hundreds of other people all getting the exact same outcome. You inherit cost bases and things like that. Whereas we were very early on into individually managed accounts, which allowed us to manage money for clients on a discretionary basis, but tailor it to their individual outcomes. And that has since evolved into what's called separately managed accounts. So you've got the three. The least flexible is unit trusts, then you've got separately managed accounts, and then you've got individually managed accounts. And we're probably one of the few that can really do individually managed accounts at scale where they legally and beneficially own the assets.
And the company's evolved a lot. You talk about being the band of 30 individuals, and now it's probably close to 100 people, working at Elston. The establishment, the asset management business, a lot has changed and over a period of, close to 2 decades. What's evolved in the most interesting way for you, but also I guess what's still the same? What do you think is still at the heart of Elston that's the same?
I think at its heart, it's still a small business. So what's evolved is we probably have more defined roles than we used to. You used to wear many hats, and as we've grown over time, you can wear less hats. But probably it's a time thing that is the most difficult to manage, where you just get pulled in different directions. But you've got to focus on what it is you do as a day job as well. So it's probably more people. I mean, people is always, I think, the most difficult thing to manage. Everyone has different goals and different aims and different career aspirations. And I think trying to tie all that into the one business is challenging.
It's challenging. I imagine the number of hats that you would have been wearing in the early days of asset management, and you'd be, I guess, portfolio manager for everything. And then gradually you've sort of moved to, large caps. You are small caps. You're also involved with multis. You're still sort of wearing a lot of hats. And, is that a bit of a challenge?
Yeah, it is. And it's just a time allocation. I think you can always aim to reduce the number of hats that you're wearing, but ultimately you do get sucked into that vortex from time to time. But the key is, as a business, really aiming to bring on people that are better than what you are. And so we're gradually doing that. We're really looking to sort of split the teams into their own units and bring on people that are better than what the existing people are, with the aim of improving the output or the service or the product. So, yeah, it's always a difficult one, but you've got to continually invest in the people you have, whether they be new people, whether they be existing people with the skills that they have. You just got to continually improve what it is you're doing. Because ultimately, at the end of the day, it is a service-based business, and your customers or clients, their outcomes obviously determine whether or not you've got a viable business or not.
And obviously you still love it. I mean, the fact that you said, okay, you need to be involved in those things, it's not a burden. It's actually something that is part of the business and part of what you do. But you obviously love analysing, the economy and looking at how companies are performing and examining the trends and the themes and piecing all that together to be smarter than the average bear. Is that true? Like, what are the bits that you really enjoy in the job you have?
I think it's a curiosity thing. It's working out how they actually do it, what their secret sauce is. You could look at something like CSL came out of a unwanted part of a federally government-owned enterprise. It was plasma was a very unsexy area, and they're number one in the world at what they do. If you think about another Australian business, ResMed, in terms of sleep apnea and those types of things, and even something more relatable to people is something like a JB Hi-Fi. I mean, we catch up with them, and in terms of a management team, I think they're probably the best I've seen, and it's how the world is evolving in terms of the amount of data they have at their fingertips and how they use that data to run their business. It's amazing. In terms of, often with companies, it's the jockey, not the horse. And when you see people that are over the detail like that, it is pretty impressive. So that's the side of things that's really interesting. And also, because I'm involved with Elston, you can take bits and pieces of what they're doing and try and apply it to your own business. So it's how they actually do it is what's enjoyable about the job, working out what it is they do, how they go about it, what's their competitive advantage, what are their threats, all those types of things. It's just interesting.
You'd have seen a lot of things happen, as you talked about the GFC being
hideous.
a hideous way to start the business. But you've also seen COVID, and COVID has had just an enormous knock-on effect for a number of years, and we're still seeing the outcomes from all sorts of government decisions play out, supply chain disruptions. How do you observe that?
Well, it started even before COVID, in terms of, for the 10 years before that, the view out there generally was that inflation was dead. You were never going to see inflation again. The reserve banks or central banks had done a very good job in containing inflation. They all had inflation targets and things like that. Then you had COVID, and that was, the world is going to change here in terms of people couldn't go to work. So now we've got hybrid working arrangements, and all those types of things have come in. You had a massive amount of government intervention. And so you had this environment where people were restricted from doing what they usually did in their daily lives, whether it be go out to dinner or go away for holidays or what have you. And And so they were being told they can't do that. And so what they do, they sat at home and got online shopping and did up the bathroom or bought a new TV or set up a home office. And so you had this massive demand surge because they couldn't spend money where they usually do. And so they spent it on other things, usually based around home, which created a massive amount of demand. At the same time, supply chains were disrupted. So a lot of cargo gets shifted, as an example, in the belly of planes, and planes weren't flying. So you had this massive demand for shipping as a byproduct. The cost of shipping went through the roof, and hence that's the start of the inflation. And so you also, at the same time, had an enormous amount of government stimulus. So here we had, was it JobKeeper and Job
Seeker?
Job Seeker and JobKeeper. I can't remember. It's
something like that.
It's in the rear vision mirror. And so you had an enormous amount of stimulus come in. So the government's really loosened their wallets and spent. And I can understand why they did that. And I can understand that it was for a limited period of time. But once governments start really shelling out money, it's very hard for them to pull it back out the other side. And we still see now that there's a lot of stimulus in the system, and hence, inflation has come down from its peak. It was originally a supply side issue, and then it was a demand issue, and it's still to an extent a demand issue. There's still a lot of fiscal stimulus out there. The Reserve Bank's lifted interest rates to try and reduce the amount of demand, but you've got central bank and government working against each other is what you've got at the moment. And that's why that last yard down into the central bank's inflation targets is probably going to be pretty difficult.
So it's felt like a bit of a blunt instrument because of all that money awash in the economy.
Yep, absolutely. So the accumulated savings during COVID was huge. And so the consumers have worked through that now. And hence you've got, prices have gone up. The US has still got a fair amount of it as well. Trump's policies, they're going to generate, depending on how hard he goes, you may see a little bit of that tariff. They're inflationary. Ultimately, it's a tax on the consumer.
So when you think about that, it's hard to not talk about America without talking about Trump. You think about his policies are obviously enormously or potentially disruptive, but potentially there would be some positives as well. How do you actually view the Trump factor and what that might do in the next 12 months?
Well, you just don't know. One thing you do know, he's very transactionary. It is a big stick that he wields. It's the largest economy in the world, strong environment, low unemployment, good growth rates, and they are spending. And probably this is one area that concerns me longer term, but no one cares about it shorter term, is every government's running fiscal deficits and there's no plans to rein it in. And at some stage, they're going to have to work out how to deal with that. It's almost a form of intergenerational cruelty because that debt gets left to future generations is the way I've heard it described, and it's probably quite apt. So there will be no less uncertainty with Trump. I mean, we've gone from COVID uncertainties to what it looked like out the other side through to inflation, what that looked like as it rolled through. And, that sort of seems to be coming down and quite under control now. But you've still got governments working against central banks in terms of one's trying to cool it down, the other one's trying to speed it up. And then you've got geopolitical, which is, Trump is front of mind at the moment. It's
unusual to see a government and a country as big as that move that quickly, to be that agile in his first week to sign X number of executive orders.
Saying something and getting it through are probably two different things.
Yes, it's almost like, as you said, he's not behaving like a government. He's behaving like a deal maker, and he's throwing things out there just to get people on their heels.
Yeah, he's behaving like democracy doesn't really matter. I mean, but he won a big election. He would say he's got the mandate to do things unilaterally, and that's what he's doing.
How has the market reacted? The little bit of a correction on the American stock market with the tariffs being announced?
Yeah, well, I mean, it's funny. The world's spent, it's probably since the mid-1980s, the world's spent its time becoming a global economy. And so that was getting rid of tariffs and free trade agreements and all those sorts of things. So they've started to turn inwards again, countries. So a really simple example might be in Australia, our drugs were produced in, say, India, for example, and they couldn't get drugs into the country. So they're saying, well, now we need onshore manufacturing. If you think about Australia, what gets manufactured here these days, there's not a whole lot. I don't know if you watch a TV show called Mega Factories, but I was sitting there watching that one Saturday evening, and they had John Deere in the United States, and all these robots were producing combine harvesters, and combine harvesters are pretty complicated pieces of machinery. And then the next show was a show in Queensland called the Great Southeast, and they went to the Quintrex factory, which build aluminium dinghies. And there were 4 or 5 guys welding a dinghy. And I just went, Australia's not got a lot of competitive advantage in manufacturing these days, I don't think. But it's the areas that Australia, they say we can win out is agriculture, financial services, education, and tourism are the areas where we have a competitive advantage. And we're not really pushing those competitive advantages, I don't think. You know, if you look at the current federal government and the schemes that they're looking at implementing to drive manufacturing onshore are good examples. Solar panels, we have no competitive advantage there at all.
Could we build them at the right price?
Yeah, no. Well, not without subsidies. And again, a subsidy is a good thing. Probably not. We should be focusing on the areas where we can compete, and I don't think that's what's happening.
It's a difficult thing for governments to try and manage, though. I guess they're planting a flag on the hill and saying, this is where we'd like to go, and obviously running some advertising that says this is what we're doing. How we get there, and as you said, whether it's directed to the most profitable areas is very hard to predict. I guess even in terms of mining and precious minerals, is that going to work for Australia?
Yeah, well, that one potentially will, because we are really good miners. And so, precious metals are obviously required going forward. So that is one area where we potentially can win. And to get the industry up and going, it probably requires some form of subsidy. But what you don't want is a big black hole that money gets poured into and there's no tangible benefit out the other side. And that's, I think, where governments struggle to draw the line.
Just going back to America for a second, if we think about, they've been doing very well. The stock market's been very healthy. There's obviously been the Magnificent Seven. Can that be sustainable? We saw when China, once again, threw a nice little sort of press release out there about being able to do it smarter and cheaper with DeepSeek.
Yep.
And I think that maybe that had a little bit of a ripple through the market. Can the Magnificent Seven stay magnificent?
Yeah, well, I mean, they're very, very strong businesses. If Facebook is an example, or Meta as it's called now, Microsoft, they're all very, very good businesses, and they are very good at what they do. But an enormous amount of future outcomes is priced into them at the moment. So they are, trading on reasonably expensive multiples. There's a lot of growth factored into them. And with forecasting, there's always risk. And it comes down to the maths of it in terms of your future value comes down to what that is brought back into back into present day dollars. And it's the discount rate required is a massive variable. That's probably a little bit sort of technical. But the point is that nothing's guaranteed. As we saw with AI out of China this week, they're all spending an enormous amount of money on AI. And if the Chinese are able to do it more efficiently, less expensively, well, then it is at risk. But you got to love the Americans as they are very innovative and they are very resilient. Anytime people write the Americans off or the American market off, it seems to bounce back better and stronger next time. So potentially they can hold their advantage, but index concentration is something that is a risk probably for investors more broadly in terms of, in Australia, we've always had a very concentrated market. We've got 4 very large banks and we've got 2 very large, or now 3 very large miners that represent over half our market. And so a company being a very good company is one thing. The risk you're taking on by owning those companies to market weight is something else altogether from an investment perspective. Your concentration risk is huge. And for the first time, the US has got to deal with that, and from an investment perspective. So, I think they will probably be very strong for quite some time, but they're not without risk is how I'd position it.
We're talking about all these things that are hard to predict. We're very much sort of aware of the factors. From an Elston's asset management team, when you look at a long investment horizon, you're talking about 5 or 7 years ahead. What are some of the major themes then? You've talked through probably quite a few of them, but what are the key themes that I guess that your team are really looking at? Well,
if you bring it right back to shorter term, probably the most important thing is what is actually in the price. So what are the expectations? So what we're trying to do is trying to work out how they're going to grow their top line, what their expenses are going to do, and how that flows through to their underlying profitability. And that comes down to the type of business that it is. If you're a mining company, you're essentially a price taker. So you're not in control over the price it is that you're selling a product for. So making sure you don't overpay for that type of asset at the wrong time in the cycle is probably the most important thing there. If you look at something like, I mentioned it before, say ResMed as an example, a lot of it comes down to their product. So what are the threats to their CPAP machines? And they have an advantage there at the moment, but reinvesting back into that advantage is critical. So looking at the amount that goes into research and development and what they're doing with it is really important in order to maintain their advantage over their competitors. The size of the market that they're actually looking to address. So Australia is a reasonably small economy. A company can do very well here, but at some stage, if they do really well, they are a large part of the market. We are an economy with a lot of duopolies or oligopolies in there. If you think about groceries, you got IGA, Woolies and Coles. If you think banks, we've really got the big four and then some regional players. So there aren't that many competitors in our market. Over in the United States, for example, it's completely different. You've got a population, I think it's about 330 or 340 million. They don't have that sort of concentration amongst their businesses. So there's opportunity for interlopers to come in and take market share. But, again, they used to say Australian companies, went to the US to die. And there was quite a bit of truth to that. But Australian businesses have got a lot better about that in recent years. And we now have, I could list them off. If you looked at Macquarie, if you looked at Brambles, you looked at Amcor, you looked at ResMed, you looked at CSL, James Hardie, all of those have massive US operations. In fact, they report in US dollars and the majority of their revenue comes from there and they're success stories. So they've outgrown Australia, taken it overseas and done really well. So forecasting is always with risk. One of our analysts can spend an inordinate amount of time building an enormous spreadsheet forecasting out 5 years. But if your factors are slightly wrong, your output's going to be wrong. And so you've just got to the way I think about it is you just want to be a little bit conservative of what it is you're putting in there. But more important is the type of business that it is and where it sits in the market and what it's actually doing for its product.
And given that so much is going on all the time, as you said, you can be conscious of a long-term plan. You can map out what's the likely scenario, how you think it's going to play out. But you've obviously got to keep revisiting those things in the short term again and again. What happens with the Elston team? How often would you regroup? I know that you've probably, you're in each other's ears, every day. But how often, what is the process in terms of reviewing and revisiting and bringing in fresh information?
It's pretty constant. I mean, we have two major periods where the companies report each February and August, so half year and full year results. You're also speaking to companies in between those periods. You're also speaking to their competitors or their suppliers or their customers. And what you're trying to do is narrow in on the right financials, essentially. You're always on the lookout for competing products or substitutes, those types of things as well. So it's a constant thing. So in the large cap, it's the ASX 100, which isn't a massive universe in the overall scheme of things, 100 companies between a whole group for us to look after. But those companies tend to be quite large and they tend to be across multiple jurisdictions and they tend to have multiple business units. And so there's a fair bit in each of those companies. And so it's a constant. And then you also got to look at the ones that you don't own. And that's probably as important, if not more important, the ones that you do own. So it's a constant process. And that's where probably technology's really helped us. We got really good systems in the back end where, if someone does a research note on a particular business, everyone can see it. It used to be emails and spreadsheets and all those other bits and pieces, but it's a lot more advanced than that now. So technology is making it easier for us, but it's a constant process. It never ends.
And Elston's pretty tough on decisions, I would imagine. You talk about, looking at what's outside the portfolio is often as important or maybe more important than what's in the portfolio. If someone brings an idea forward and says, I think this company is something we really need to keep an eye on, I guess it doesn't go in straight away. It can be quite a process before it would actually get the nod. Is that true? Or is that always true?
It's something we really value as a team is thinking about things differently to each other. So I think one of the biggest risks in a business like ours, which is funds management, is that everyone thinks about things the same way because it's almost self-reinforcing. Whereas, say out of Andrew, Joe, Leon and I, who are the large cap team, we do think about things very differently. And we think that goes to the quality of the decision-making in terms of if an idea is brought to the table, it has to get through each person in order to get into the portfolio. But then it's actually got to displace an existing holding potentially, or you have to sell multiple holdings in order to put a new asset in there. And so it all comes down to risk-adjusted returns at the portfolio construction level. So, what is this new holding potentially adding to the portfolio? Is it adding to the risk that you're taking on as well, or is it decreasing the risk? What is it displacing, and what does that mean for your portfolio structure? So there's all that type of work that goes into it. And it's actually something we got a lot of grief about from the rating agencies, where we have to get rated in order for external advisors to use our services. And we got a lot of grief that there wasn't one star portfolio manager. And
that'd be you, Bruce. Wouldn't you be the star?
I'd like to think it's me, but it's probably not. But we always said to them, well, the risk to the end investor is that something happens to that one-star manager or that one-star manager is wrong. We all have our biases. There's no way around that. I look at things differently to Andrew, to Leon, to Joe, because we all have our biases. And we think that collective decision-making lays off a lot of those biases, and also means that if I get hit by a bus, things just roll on. The process is embedded, the structure of how we do things is embedded, and it's just another person would step into my shoes and the world would move on. So we think that's about risk to the end investor, and laying off that is as important as laying it off in the portfolio itself by the securities that you select.
I don't imagine it would also be true that you would come in with individual perspectives just through normal experience. And often people are very close to a particular product and believe in a product because they go, well, I actually have it in my own life, in my house, in my garage. I use this and know it, and therefore I've really become passionate about investigating it, and I really understand why it works in the marketplace.
Yeah, well, I mean, it might also come down to your previous experiences in the role, where you might have bought something that worked out poorly for you. And the easiest thing to do is go, I will never buy that security again. And that is what you should not be doing. Things change over time. And, you do have, it's funny, there was an old company, Queensland-based company called Mount Isa Mines, and it just got this reputation there was just always a problem. Every time they reported in August and February, it just became troublesome. It was accident prone. And the easiest thing to do would go, well, I'm never buying Mount Isa Mines. That was probably the right thing to do, by the way. But that's just an example that comes to mind. But, you've got to look at it each and every time as though you've almost never looked at it before, with a clean sheet of paper. Otherwise, you just mentally dismiss things that you shouldn't.
That's a great summary, Bruce. Thanks for all that insight on what's happening in the markets and I guess the things that we all need to keep an eye on over the next year. We'll look forward to seeing how that plays out. And at the same time, it'd be interesting for everybody else, I think, just to see how Elston keeps evolving, because it's been a fantastic journey and it's interesting to see where it goes next. So thanks for coming in today, Bruce.
No problem. I've got grey hair now. Next time I do one of these, I'll probably have no hair.
Well, we look forward to that. And when you have no hair, we'll bring you back for the next session.
Thank God it's not on camera.
That's all for this episode of FM Radio. We hope you can join us again soon as we tune into another aspect of funds management that affects you and your clients. In closing, I'd just like to say that Elston acknowledges the traditional owners of country throughout Australia and acknowledges their continuing connection to land, waters and community. We pay our respects to the people, the cultures and the elders, past, present and emerging. FM Radio was recorded at the Pod at Cutting Edge Studios, West End, Brisbane. It was hosted by Peter Goodall, and today's guest was Elston co-founder and portfolio manager Bruce Williams. For more FM radio episodes and full transcripts of the interviews, visit elston.com.au. And if you'd like to subscribe to our podcast series to make sure you don't miss a thing, you'll find FM Radio on your favourite platforms, including Spotify, Apple and Google Podcasts. The information provided in this podcast is general in nature. You must consider your own circumstances prior to making any investment. For more information, go to elston.com.au or speak to your financial advisor. Elston Asset Management is authorised by EP Financial Services, AFSL number 325252.